Understanding economic impacts on company growth.
Hello, and welcome to our discussion today. We are going to delve into an exciting and fundamental aspect of business operations, how external economic factors such as inflation, exchange rates, and government policies can impact the growth of a company. This knowledge can be essential for business leaders, investors, and even consumers, so let's get started.
How does inflation impact company growth?
Inflation refers to the general rise in the prices of goods and services over time. While it's a normal part of most economies, excessive inflation can have significant effects on a company's growth. When inflation is high, it increases the cost of raw materials, which in turn raises the cost of production. As a result, a company might be forced to either increase its prices or reduce its profit margins, which can lead to lower competitiveness and reduced sales. Furthermore, high inflation can also discourage consumer spending due to the reduced purchasing power of money, leading to a decrease in overall demand for goods and services.
What role do exchange rates play in company growth?
Exchange rates are crucial for companies involved in international trade, as they determine how much a business earns when it sells products overseas or how much it pays for imports. If a company's home currency weakens compared to its trading partners, it makes the company's exports cheaper and more competitive on the international market, potentially boosting sales. Conversely, it makes imported raw materials or goods more expensive, which could negatively impact profitability. A strong home currency, on the other hand, can make imports cheaper but can also make exports more expensive and less competitive, potentially reducing overseas sales.
How can government policies impact company growth?
Government policies can directly or indirectly influence a company's growth prospects. Policies can range from tax laws, regulations, trade policies, to monetary and fiscal policies. For instance, if a government increases taxes on corporations, it can eat into a company's profits, limiting the funds available for reinvestment and growth. On the other hand, a tax break or incentives for certain industries can stimulate company growth. Regulations, such as environmental or labor rules, can also impose additional costs on businesses, impacting their bottom line. Trade policies can open up new markets or restrict access to others, influencing a company's potential for growth. Monetary and fiscal policies can affect lending rates, consumer spending, and overall economic growth, all of which can impact a company's performance. So there you have it, an overview of how economic factors like inflation, exchange rates, and government policies can impact the growth of a company. It's a complex interplay, and these factors can have both positive and negative impacts, depending on the specific circumstances. Understanding these concepts can help stakeholders make informed decisions and prepare better for different economic scenarios. We hope you found this discussion helpful and enlightening. Until next time.